Stocks do not like it as we come back from a shortened holiday that cut the week down here for Wall Street. And of course, everybody's focus is on what comes tomorrow because though it is a shortened week, it isn't one that is short of fireworks because we're going to have on the same day, naturally, everybody's focal point on the earnings side, the report from NVIDIA, but no slouching on the macro side either as we get minutes from January's FOMC meeting. Welcome. This is Macro Money. I'm Ilya Spivak, head of global macro here at tastylive. And the question we're going to ask ourselves here, because we are a macro show, of course, is do these minutes matter? And should anybody really be afraid of them? Now, of course, there are many reasons to think that we can go one way or the other. And needless to say, there are those of us here at tastylive that think such things don't matter. But I think the argument that we're going to make here is that, as ever, it depends. It depends where the markets are, it depends what they're thinking, and it depends what the context is into which this information emerges. And so what we're going to do here is look at how Fed policy expectations have evolved in recent weeks, how they have shaped markets, and what outcomes they've generated. And so with that in mind, then what these minutes might do. What they might do to stocks, what they might do to currencies, and what that might mean going forward. So let's begin here with just a very baseline set of the moving parts. So here is a chart of the S&P 500. So call this a baseline for Wall Street. This is overall market mood. And we can see here that the last big shakeouts that we've seen on the way up here since the beginning of the year have come at the hands of the Fed and Fed-adjacent data. There's that big sell-off you see on January the 31st. That's the Fed's FOMC meeting where they come out and say, you all have been expecting runaway rate cuts. You're probably not going to get them. We are much less committed than you think we are. And although we have signaled that we think rate hikes are over and rate cuts are probably coming, you all have really overstated how much of them are on the menu and also how likely we are to actually do it given what's going on. The markets heard the Fed, they had a bad day, and then said, yeah, okay, sure, and went right back up. And so what you see here is in the wake of that FOMC meeting, the S&P has one awful session, dusts itself off, and resumes its climb. It would rise by close to 4% until it peaks again, this time the big shakeout, thanks to U.S. CPI data that comes out hotter than expected, 3.9% on the core inflation reading. That's the one that the Fed cares most about, the one that excludes volatile things like food and energy, which in any case no longer really factor into U.S. inflation. Goods inflation, as we've looked at countless times at this point, has been squeezed down next to nothing, and energy is actually a deflationary force. Energy actually contributes negatively to inflation. And so those things aren't really what the Fed is focused on in any case. Rather, the Fed is focused on the service sector where the remaining bits of inflation live, and that, of course, is really the core CPI rate. And there, what do we find? Expectations were that we'd come down from 3.9 to 3.7. We end up at 3.9. No change. Disinflation stalls. As a matter of fact, it's becoming a bit of a worrying dynamic at this point, because while December and January then end up stalling at 3.9, October and November were stalled at 4. So we now have 4 months in a row where the cumulative decline in inflation at the core level over that time has been just 0.1%. And so what we end up seeing is a very clear departure from the rapid disinflation that we saw from the peaks into this 4-month stretch. So the pace of disinflation is clearly slowing. And when the markets saw this, they, of course, got spooked, and we get another big leg down in stocks. Now, they attempted to pull off another we don't care, let's keep going maneuver like they did after the FOMC, but as we can see, that seesaw did not work out this time. So the markets attempted to reclaim momentum, ran back into what was the high before CPI, and have swooned. And now, after the sell-off that we got today, find themselves basically exactly where CPI landed them. So naturally, the question from here is, well, what are these FOMC minutes going to do? Do they have capacity to give us a push one way or another? Well, let's consider. So, this has been the way that U.S. policy expectations have interacted with the stock market. When we look at the situation from about the middle of last year through to the end, what we find is there's a very clear inverse relationship between how many rate cuts are expected for 2024 and how stocks feel up or down. So you can see here that from about the middle of the year, we start to get rate cuts diminishing out of the outlook. This is as policymakers get their hands around the SVB-led regional banking crisis, and it looks like the latest edition of will they or won't they raise the federal debt limit, episode gajillionth 0.4, we get the sense that nothing truly awful is going to happen. We will get the debt ceiling situation resolved for a time, again, without there being a big knock to fiscal outlays, which of course would be a risk to economic growth. And the SVB situation and all sort of the adjacent fireworks around it seem to be contained. So the need for aggressive easing didn't seem to be as pressing. And so rate cuts started to fade away. Markets clearly didn't like it. Fewer rate cuts here, so these bars get less negative. We go from down 1.5% expected to down 1 or even 0.75%. As that happens, stocks go down. About October, late October, early November, the markets think, oh, wait a minute. The Fed has seemingly changed its tune. And indeed, in both November and December, the Fed started to signal, okay, markets, we've probably reached peak rates. That, of course, started to initiate rabid speculation about what comes next. And so rate cut expectations built back out again from about 75 to 100 basis points right here to again about 1.5%, even at one point looking like it might be 1 3/4 or thereabout. And stocks obviously liked that very much. And then something changed when we got into 2024. We saw that rate cut expectations start to drift down, but stocks don't fall. Now, of course, here's the FOMC setback that we just saw. Here's the CPI setback that we just saw. Those are indeed setbacks. But the trend continues to point higher, even as rate cut bets diminish. And so the market is ostensibly saying, okay, fine. 150 basis points was too many. Let's get back to something that makes more sense. And as long as this is happening for the right reasons, that's okay. We can live with 3 cuts at about 75 basis points. That will be fine. That's enough easing. That can keep sentiment broadly underpinned. And the path of economic data does in fact suggest that the Fed was right, that the signaling was broadly that you don't need aggressive runaway rate cuts, because what you see from the beginning of the year is that U.S. economic data starts to perform better than expected, one release after another. You get the PMI numbers for January. They come out much better than expected. Then you get GDP numbers. Then you get NFP numbers. And then you get that hot CPI number. In between them, you get better ISM numbers, better job opening numbers. And so there's this definitive sense that the U.S. economy is performing better than economists anticipated, summarized here by the Citi U.S. Economic Surprise Index, where you can see that right around the beginning of the year, the index broke through its 20-day moving average, which essentially is just a month's worth. There's about 4 weeks in a month, about 5 days in a week, last I checked. And so that's a 20-day stretch, give or take. Some months are different than others, but the general idea here is where is the monthly trend in U.S. economic data outcomes, and are we getting disconnected from it? And clearly, at the start of January, the answer is yes. The data is starting to be better than baseline. And so, not surprisingly, over that very period of time, rate cut expectations hem in, but also the markets don't so much fear that because they say, well, look, this is not a bad reduction in rate cut expectations. This is a good one. This is the economy being strong. This should be good for earnings. Nothing to worry about here, right? Consider the difference between what happened in the second half of last year where this relationship was inverted. And look at what the data was doing then. This is about the second half of last year. The data is deteriorating relative to forecast. That doesn't mean the data is bad. It's just not as good as expected. And so what the markets are saying there is, well, if the data is going to keep deteriorating and we extrapolate that out, we're going to want more cuts. So if you tell us there's going to be fewer of them, we don't like it. Stocks go down. If you tell us there's going to be more of it, we like that. Stocks go up. Which is, of course, exactly what we see in the second half of last year. But when the data is getting good relative to forecasts, as we see here, well, then it's a different story. Stocks can go up with these rate cuts diminishing. But then, of course, there's a bit of an issue. With a stronger economy comes more inflation. And so what we find is that inflation expectations are marching higher even as expectations for Fed policy get less dovish. So the 5-year break even here is the difference between nominal and real 5-year interest rates. So you take the normal 5-year rate, you subtract from it the expected rate of inflation, and you get the inflation adjusted or real yield. Now, because that real yield is a tradable security, the 5-year TIPS bond, and you have, of course, the nominal 5-year U.S. bond as well, you can subtract one from the other and get the magnitude of the inflation adjustment that the bond market anticipates. And that's this 5-year break-even rate. What we find is that it bottomed in November and has been marching higher because the markets are indeed anticipating a hotter economy, and they're readjusting for what that will mean for inflation, which is more of it in simple terms. And what we find is that this occurs or starts to occur before the market comes around and goes, wait, this is going to mean fewer rate cuts. And so the rate for the Fed funds benchmark that markets are anticipating to see by the end of this year starts rising. That, of course, poses an important conundrum for the Fed. And this is where these minutes become so critical. Here is what the Fed said in January at this policy meeting. And the key really is in the policy statement itself. There's, of course, lots of focus on the press conference that Jerome Powell held thereafter, saying he finds it unlikely that there'd be a cut in March, which at the time was something the markets were very much thinking is a possibility. That was a big knockback, but it's the statement that offers the bigger vision here. Here are the key points. Number one, the committee expects it will not be appropriate to cut rates until it has gained greater confidence that inflation is moving sustainably towards its 2% goal. In fact, that's exactly what has come out of the mouth of virtually every FOMC official since then, although most still contend that we might need to be cutting this year, and that the cutting probably is somewhere on the order of 2 to 3 times. Next, the committee says that it would be prepared to adjust the stance of policy if risks emerge that could impede the attainment of its goals. Now, the key goal here is that 2% objective. And what do we see? Data that suggests those goals might be impeded. The economy comes out hotter. Inflation expectations are rising. The Fed might understandably conclude, well, progress toward 2% looks much less sure now than it looked in December when we said we could do 3 cuts. And incidentally, that's exactly what they said. Here's the Fed's summary of economic projections from December. And we can see that on the key Fed funds rate here, they say we are going to move from 5.4 to 4.6% from 2023 to 2024. Well, that's 80 basis points. Where are markets set now? Well, 80 basis points. Right here. That lands us just about in line with the Fed. And so the markets have essentially arrived where the Fed has been saying that they're meaning to head since December. And so now the question is, well, has more changed? Have we just seen the markets shed excess, shed over speculation to arrive at where the Fed told us we need to be in the first place? And so these minutes are going to be uncontroversial. They're going to reinforce precisely what has been going on. And so really nothing to see here. Well, maybe so, but maybe not. Because when the Fed made its January statement, what it didn't have, among other things, was that CPI number. Ostensibly, they knew that GDP was already going to be better than expected. They hadn't seen at that stage the weak retail sales number that we just got. Instead, they saw a very potent one for the prior month. But what they hadn't seen was CPI. Arguably, they had not really digested NFP, although they do get that data early. They didn't have it by the time the meeting rolled around. And so what we have since the Fed issued those statements and issued those forecasts, a run of data that continues to be tilted on the upside, and an upswing in inflation expectations that follows. And this is where these minutes become so fascinating. Now, it's tempting to say that they're basically backward looking because they're an account of a meeting that's already occurred. But they're not exactly a stenographer's transcription. The Fed releases what is essentially an editorial summary of what they said and how the meeting went. And of course, the Fed is absolutely under no illusions that everything it says and everything it publishes and every speech from policymakers is being scrutinized by markets for policy signals. So it knows that this is an opportunity to shape expectations, and it edits the document accordingly. So if the Fed wanted to signal to markets ahead of the March FOMC meeting, ahead of whatever comes next data-wise, that the warning that it gave here stands, and that the situation has evolved such that the data is arguing for a more restrained way toward cuts, and that maybe, just maybe, the risks to policy are much more symmetric than the markets have anticipated, that in essence, what we are looking at here is not so much a situation where cuts are guaranteed and the question is of degree, but maybe of direction. Maybe we don't get any cuts. Well, then, in that case, we have a very different scenario with which to work with. As we see here, we've certainly seen the curve of implied expectations adjust to a less dovish setting. So as we went from 160, 150 basis points to now 80, we've definitely seen an adjustment. In the big dashed line is the December curve. In the little dashed line, there's the January curve. Those correspond to FOMC meetings on those months. And you see they're not especially changed one to the other, but of course, since that January meeting, there's clearly been a hawkish adjustment. The current curve in the solid line there is much less steep. It nevertheless points lower. And so what we see here is here's the current rate. We see ourselves holding here in March. We start to get closer to cutting in May. The probability starts to get better than even that we get a cut in June, and by July, it is certainly there. The markets already discount that the cut is in by July. When we look at where we are at the end of the year at 4.5%, that's that 80 basis points. And so what we essentially have here is the markets and the Fed in alignment, and the question now being, does the Fed need to be tighter than the benchmark that it established in December because the data has become better, clearly, and the markets are anticipating more inflation, clearly, as a consequence. So if the message in these minutes has been massaged such that it appears policymakers are far less convinced in the case for rate cuts in general, not just quibbling over how many and on what time scale, well, then there's a very big adjustment to be made in fact. And in fairness, we also have obviously earnings from NVIDIA, which is a huge market mover and could have tremendous consequences. So it isn't necessarily clear that we are going to get a clean response from stocks. After all, we've just watched them be of two minds about whether rate cuts are something that hold stocks back or don't, looking at the relationship last year versus so far in January and this month. But one spot where this has been unambiguous is the U.S. dollar. The U.S. dollar does not have a conflicted relationship with policy expectations. Fewer rate cuts is a stronger dollar. More rate cuts is a weaker dollar. We can see that the path for rate cuts and the path for the dollar's average value against its major counterparts largely move in lockstep. So if, in fact, these minutes tell the markets, hang on a minute, it's not enough to get back to 80. 80 basis points is what we thought in December. But how the data has evolved now suggests it could be less, and the risk is much more symmetrical and much less skewed toward cuts than you all anticipate. Stocks may yet figure out what to do with that one way or the other, and certainly look vulnerable. But the outlook for the dollar in that scenario is much more lean cut and bullish. And that is Macro Money for today. This is actually our only show for this week. It's a shortened week and live shows of actually both overtime, the other show that I co-host with Chris Vecchio and Dylan Radigan, as well as this show. Both of those are going to be off for the rest of this week. I'll be back next week for regular scheduling, Monday through Thursday for both overtime and Macro Money. In the meantime, we're going to get PMI data out of the major economies on Thursday, and we already covered it on Macro Money last week. So definitely go and check out those video on demand episodes, also on YouTube, where we talk about what all of that stuff might mean. In the meantime, good luck out there. We'll check back in on all of this next week. Take care.